how do you raise capital? So I've heard many people say to me, Dr. Steve, I want to do investment, but the problem is I don't even know how to raise funding, or I have started, but I don't know how to scale the funding to be able to get more people to invest, in what I'm already doing and things like that. So we are going to take that. By the way, did you guys enjoy the session, Mr. Rana? If you did, kindly type great session. Again, type great session if you enjoyed that session. Okay, and if you're ready for me, just type I'm ready, I'm ready. People asking, is this recorded? That's why I'm asking them to put it on, stream it. So you can go to my YouTube handle, Dr. S. Akintayo on YouTube, and you can watch it, okay? Both all the sessions we've done. Subscribe to the YouTube channel and you're free to watch it. So if you're ready, type I'm ready, I'm ready. So we'll look at this subject of capital, right? Raising capital for business, expanding your business and seeing how to leverage and things like that. So capital is the lifeblood of any real estate investment. Whether you're purchasing property, developing project, or expanding portfolio internationally, raising capital is critical. And you can't even joke with the subject of raising capital is key. And so how do you raise capital for real estate? In this session, I want to explore the global real estate landscape. I want to look at the type of capital available for international projects, proven strategies to attract and secure capital from global investors, key consideration, risk and opportunities in the global real estate market. So the global real estate market landscape have economic factors. So real estate investments are influenced by what? Microeconomic factors like inflation, interest rates, and geopolitical shifts. So I want to ask you guys a simple question. Can you mention an economic factor that is discouraging when it comes to investing in Africa? Okay, who wants to type that in the comment section? What are the economic factors that is discouraging investment, investing in real estate in Africa? Anyone? I just want to be sure they are really following. Someone saying insecurity, someone say inflation. Okay, yeah. So inflation, you are very correct, is number one. The rate of inflation is crazy. So it's affecting cost of construction, and you also have devaluation of the currency as well. So instability when it comes to the currency. Security is there, but the two major issue when it comes to investing in Africa is this issue of inflation and instability with the currency, because most building material, what we used to build, are imported, right? So, and once the price fluctuates, it just affects the pricing. So something you're supposed to build, let's say 5-bedroom for 150 million, before you know it is grown to 200, 300. So we also have market growth. So real estate market has seen consistent growth globally, driven by urbanization, rising wealth, and low interest rates in many regions. The other landscape is emerging markets. So emerging economies like South Asia, Africa, and parts of Latin America offers higher growth potential, but they also come with what? Higher risk. So I'll give you an example. It's only in countries like Nigeria, you can buy a land and it will grow by 100% in 1 year. How many of you agree with me? Like you can buy 100%. In fact, it's only in Nigeria you want to buy a land in bulk, okay? And then they told you, I have a land now. last year, August, they told me they were going to sell the land for me at 55 million per hectare. I kid you not. August. January, I was told if I don't have 130 million per hectare, they don't even want to talk to me. Okay? If I don't have 130 million per hectare. Now that can only happen in emerging economy. Okay? But just like we said, those are also very risky economies. And that's why for those of you who are raising other people's money for expanding real estate, you really must analyze the market you're investing that money into. Because if anything happens, and you know your people, many of them don't even want to be, they don't believe things can go wrong. If things go wrong, then you are a thief. I don't know if you know what I'm talking about. In Africa, if I invest with your company and then there's even a delay in paying me my returns, then you're already a scammer. Then you're already a thief. Then I don't trust you. Right? Come on, if you can relate, type I can relate. I love a very interactive class in case you're just joining me for the first time, right? So if you can relate, type I can relate. So if you're going to raise capital for expanding your real estate business, you must really factor in some of what we're talking about. You must understand which economy are you investing in. You must understand the challenges that normally occur. You must be conscious of what you're going to face and be prepared to manage uncertainty. So in developed emerging economy, you get more profit but higher risk. In developed economy, you have lower returns but what? Lower risk. You see how it works. So example, people tell me, oh, why am I getting 10% in 18 months investing in America? What they don't even know is that it's 4% institutional investors are giving you every year in America. Yes, you heard me. 4%. Okay, so if somebody is giving you 10% in 18 months, that's a lot. Why? America is a developed economy. Are we learning, guys? If you're learning, type I'm learning. America is a developed economy. So the return is lower. Now, hear this. How many of you, by the way, are joining us from America or from Canada? If you're watching from America or Canada, just type Canada, type America or USA. If you're watching or if you're also joining from UK, UK is also a developed economy. So if you're watching from Canada, USA, UK, just type Canada, type USA, type UK. Okay? Nobody is watching us from Canada. Nobody here is from US. Nobody here is from UK. Something wrong here? Okay, beautiful. So I can see you guys suddenly. Now, how many of you in the US and UK have done an investment with somebody that promised you 20% and 40%, and you gave him your money? I want you to be honest with me. And of course, you eventually lost your money. Or you are still about to lose your money. Capital, interest, everything. Yeah, talk to me. I want to hear from you guys. Those of you in UK, those of you in US, those of you in Canada. How many of you got somebody who say, oh, there's this opportunity, I'm going to give you 200% every year, or I'm going to give you 40% every year? Come on, I want to type. I know you have, so don't pretend here. And then you give the person your money and you lost your money, or you've given the person your money and there's no guarantee you get back your capital or your returns. The honest truth is this. This economy don't give that kind of returns. Are we learning here? Okay, to think that you can easily just get that kind of return in the US, 20% every year, right? 40% every year. That, from somebody trading business, so not that it's selling cocaine. He does business with your money. He then gives you a return. and it's giving you something that high. That's not how it works. It's a developed economy, right? So they cannot give you that kind of return. Are you even aware that if you are earning over 25%, okay, in some sectors in America, it's called price gouging. Are you aware? If you're aware, type I'm aware. If you're not aware, type I'm not aware. And literally the government can come after you, right? Is that you are overpricing in developed economy. So they expect that if you say you are making profit in business in developed economy, they're expecting you to say, okay, yeah, I'm making 10% profit, 15% profit, max 20% profit. Once you are beginning to talk certain figures, the regulators can come after you to say you are overpricing your products. Again, are we learning? Come on. So when somebody then comes to you and tell you, I'll give you 40%. So you see where the problem is. And it's the major reason why many of us are in developed parts of the world. We've been losing money and we've been blaming everybody except ourselves. Right? And why? Because it means you are not financially literate to even understand what are the kind of returns based on the economy. Now, in Nigeria, yes, you can expect a 20% every year, you can expect a 30% every year because it's an emerging economy, it's a developing economy, but there's also a risk, which means you can lose the entire money in Nigeria, you can lose the entire money in Africa. And if you lose it, it's not that those people were scammers or they wanted to cheat you. Anything can happen. These are economies where you can do everything right and still end up being wrong. These are economies where I always say sometimes that Nigeria is a country of bully for the bully by the bully. We have a property now, fully paid, did everything by the books, everything by the books. And one day we just got a letter, somebody saying, well, he's the owner of the land. How? He's able to go and falsify documents and come. So if we don't have strong lawyers, if we don't have structure to defend our land, we're going to lose it. So if we come back to the investor and say, well, sorry, we lost the land, everybody says, he's a thief, it's a lie, they didn't lose anything, right? They are scammers. But that's not true because we're dealing in a very volatile, riskier environment. People wonder, you're doing so well in Nigeria. Why did you expand to Dubai? Why are you expanding to US? It's because I understand, yes, there's huge profit in Africa, but it's risky. Everything can go one day. So we needed to balance it. We needed to diversify across continents, right? I was checking a story and somebody said he forgot a $20 million in a particular account. Okay, 20 million dirhams or something, one of Dubai's billionaires. And when the market crashed in 2008, that was what saved him. Because everything crashed. So was that money he forgot he even kept it in that particular account that he was able to use to bounce back. So, importance of capital in global real estate investment. By the way, again, are we getting value? If you're getting value, type I'm getting value, I'm getting value. So what is the importance of capital in global real estate investment? Number one, acquisition and development. Real estate transactions often require substantial upfront capital for acquisition. This capital is also needed to fund property development, renovation, and improvement. Number two, cash flow and operation. Capital is needed to cover operational costs such as property management, maintenance, taxes, and insurance. Number three, enable market expansion and diversification. Capital allow investors to expand beyond local markets and enter high growth region worldwide. Diversification across different countries reduce risk and increase profit potential. Number four, drive property development and innovation. Funds are needed for construction, for remodeling, for infrastructural improvement, work capitalization, and so on and so forth. So, hey, you have to have capital to do real estate. And real estate, generally is a capital intensive business. It's a capital intensive business. Jamie, I just checked Facebook again. You are not streaming. Can Jamie unmute himself and tell me why he's not streaming? You have an issue with streaming on Facebook up till now? Because I told you to chat me up and give me answers. If that's the case, then stream on Instagram. Even if you have to use a phone or use StreamYard. Stream also on Twitter and LinkedIn. Okay? So if you have issues streaming on one particular platform, then try and leverage on the other ones. Okay? Number 4, we have drive property development and renovation. I think funds are needed for construction. I mentioned that. So let's look at type of capital for global real estate investment. Are we ready? Type of capital. Now we're getting to the meat of today's training. What are the various type of capital for real estate investment? Number 1, we call it equity capital. Everybody type equity capital. Now, equity investors provide capital in exchange for ownership in the real estate asset or project. They receive a share of the profit and in some cases voting rights. Number 2, debt capital. Come on, I need an interaction here. Debt capital. In the case of a debt capital, it involves borrowing money through loans or bond, which must be repaid with interest. Now, we do more of this in a very big way, where, by the way, Mr. Rana, you are yet to come up with a proposal for halal investment. You're a Muslim yourself, and we've had a lot of Muslim folks talked about need for halal investment. So we've not heard from you on that. When can I get that?
Surely, sir. I think we did mention once one of our webinars. I think I'll come up with a presentation, sir. Maybe whenever you want, I will share with you, and maybe we'll do in the next webinar whenever we schedule, sir.
And so, what timeline do you give me? In 2 days, in 3 days, or when am I getting it?
So you will get by Monday. So I want to put up some good Islamic research material. By Monday, you will have my stuff.
Okay, good. So Monday will be. So, so in the case of halal, which hopefully we'll share with you guys later, is not the same as debt capital. It must be a portion of the interest that is being shared. Muslims have a belief that getting interest is against Sharia law, so they rather prefer that they give you money for investment, yeah, but out of the profit is what you are giving them. Funny enough, is the same, but there's just that belief, because in the case of GTEx, it's out of our profit where we can give you your return, but I think they don't want an agreed percentage, right? It just has to be. But again, I look forward to Mr. Rana's presentation of how.
Yes. So fundamentally you said right. It looks similar, but in few things, when we say basic terms P&L loss, so typically nobody look at the word L, nobody want to share the losses. So this is what typically Islamic financing does. Although their whole structure is based, we are giving you this money, you do invest, and we're gonna share profit and losses both. But eventually there are benchmarks. I've been dealing with Islamic banks. Dubai Islamic Bank is one of the largest in Middle East. I haven't seen them sharing losses with any business. Anyhow, sir, I'll come up with a presentation, so we'll discuss in more details.
Okay, I look forward to that. But like I said, I mean, I love that because any investor coming and saying, hey, if we lose money, we share it. If we make profit, we share. I'm like, that's heaven when it comes to raising capital. Those are the kind of investors you really want. So debt capital involves borrowing money through loan, and we do this a lot, right? So it's a debt, you are the first set of people we pay before investors in GTEX. We prioritize, and that's why we paid over $1 million. Everybody type $1 million. Can everybody type $1 million? Right? In 3 years plus, we've paid over $1 million to investors. And I'm proud of that. As a company, I'm proud that we've been able to do that. That for me is something I am forever grateful that our company is there, because that is families making money, being able to pay tuition fee, being able to help, do things because we exist. So hybrid capital, a combination of both equity and debt, providing a balanced approach to raising funds. So you have the hybrid where you are combining both equity and debt. So we also do this. There are some people we're working with them based on equity, some people we're working with them based on debt. Again, are we learning? For learning type, I'm learning. So what are the sources of raising capital, which is the core of today's training? Okay, where are the places I need to go to if I want to raise money for my real estate deal? Number one is called private equity firms. Everybody say private equity firms. So a private equity firm pools funds from investors and use them to invest in large-scale projects. So GVest is a private equity firm. Okay. And basically what GVest does is pool resources together. Is Queenette here? Can admin please pull up Queenette? She's our acting MD for GVest. Okay, if admin can pull up Queenette. Okay, so GVest is a private equity firm of some sort, because we pool funds together. I think GVest is a combination of both crowdfunding and a private equity firm. So the second way to raise funds is institutional investors. Now, institutional investors are such as pension fund, insurance companies, sovereign wealth fund. They typically invest large amount of capital. Okay, very large amount of capital. There are some, and these are the places where Mr. Rana has played. There are some of these institutional investors who will tell you, if you're not raising $100 million, don't even talk to us, right? They don't do if there's no enough meat in the bone, they are not ready to get involved. Number three, you have crowdfunding platforms, online platforms that allow small investors to pool funds, collectively invest in real estate projects. So these are willing to take higher risk in exchange for potential higher return, often on early stage project or emerging market opportunities. Okay, so please don't joke with these three sources. Now, let me also say here that you can set up your own company. Okay, so what do I mean? What GTEX had to do, and these are just sharing with you trade secrets. What GTEX had to do was, at some point we realized we needed to now set up sister companies that then do this, so that a subsidiary of GTEX is focused on just selling properties, right? While another subsidiary of GTEX is focused on what? On doing these things I just mentioned. I hope we're learning here. So this way, we're able to then have that opportunity for an amazing investment going forward. And for me, it's something that really, really gives so much joy to be able to do. Really so much joy to be able to do. So, let me see. So you can set up your own subsidiary companies, who may not be an equity firm, can be a crowdfunding subsidiary, can be a pension company. By the way, we're trying to apply for a pension license, as well as we're applying also for an insurance license. So the goal is to do micro insurance, right, and micro pension to start with, and then we grow to a larger scale, as well as HMO as well. Now, sources of capital for global real estate investment, right? Personal savings. So bootstrap your investment with your own personal savings. Now, I want to ask, a lot of you say you are in this class because you want to learn about raising capital. So I want to ask, how many of you here have some savings, for expanding your real estate business? And can you type the amount? The money is seated there, or not that you go and get it. Okay, I'm waiting. Go ahead and type in the chat box. How much do you have, in your savings that you want to use to expand your real estate or start your real estate business? Okay, let me see in the comment box, because that's where you start from. I will never advise even my enemy to start real estate expansion from day one, taking institutional money or taking loan. It's not right. Okay, start with your own personal money first. And that's the wise way to go. After you've risked your personal money for a while, GTEx did not set up GVest until 7 years in business. Are you aware? 7 years in business before we set up GVest and even started getting people like Mr. Rana, who understand institutional investment and can help us get institutional funds. So you want to start with your money, risk your money, take risk with your own personal money and see how that goes. After you've mastered it a bit, now you can then start taking other people's money. This is the golden rule. I'm waiting for others. So if you have zero money, put zero now. Come on. Suddenly nobody is typing. Thank you for those of you. I've seen just 4 people or 5 people have stated how much they have in their savings to go into this business. Okay, yeah. If you have zero, type zero. Okay. And if you have zero, then you shouldn't be in this class. You should be in what we call the Realtors class. The 30-day challenge class is where you should be. I started real estate with zero. Yes, zero. But I didn't come for class on how to raise money. What did I do? I went to class on how to sell real estate for other people. And I then turned what they were giving me as commission to become my capital. I hope we're learning here. So the commission I was getting from those other people became my capital. And that's the real way you want to start. So if you have zero, you want to say, GTEx, how can I sell GTEx property and get commission from GTEx? So that at the end of the day, I will be able to use some of the commission I'm getting from selling GTEx property towards buying my own property. Are we learning? Okay, I'm waiting for others. I need everybody to state the capital they have. If it's zero, type zero. If it's 100,000, type 100. How much do you have in your savings right now? Let's go, everybody. Okay, I want everybody to state what they have in their savings. Very important. Okay, that expanding your business starts with your savings. So you 2 ways to start saving. Okay, start saving. Secondly, start looking for alternative sources of income. Right, start looking for alternative sources of income, and make sure this alternative source you save it, because sometimes people are making alternative but they are not saving. Right, so I hope we're learning from this class. I can see all your comments. I didn't want to mention your amount, but I'm seeing it. So keep typing, what is your capital? So that's where you start from. Raising capital for your business, you start with your own savings. Number 2, way to raise money is bank loan, traditional financing options. So you can go to the bank and take a loan. You can take a loan from a cooperative. You can take a loan from, private equity firms. You can take a loan, basically loan, right? And the third way is called joint venture, partnering with other investors. Another way is partnering with a developer to say, you have this product, can you give me a period of so to raise the capital to pay you? This has been one of the biggest strategy I've used, where I'm buying a property, I make a down payment, and I then request for a longer period to be able to pay for the property. So joint venture is very powerful. You can even do joint venture in the case where you don't have a land, but you are good with selling, where you then say, okay, you get an architect, you design what you want to build on the land, you sign a document, ownership formula, and then you put a price and you start selling the house on off plan. As people pay, you build the house for them, okay? And you will have factored in how much you have raised, and how many units of the house will be yours, and how many will be to the person who initially gave you land. Okay, and at the end of the day, you'll be shocked. You build 20,000 units, and if you're sharing 50-50, each of the landowner takes 10, you take 10, but typically you take more than the landowner. So you may end up taking 12, the landowner takes 8 units. And when you are selling the off plan, you are pricing in such a way that the money you are raising will build the entire 20 units and plus profit for you. Are we learning here? Okay, so let's look at strategies for raising capital. But before I go to strategy, are we learning? Is this class helpful? Are we sure this class is helpful? Right? And I hope all of us are also learning some things we haven't done right? Because I was asking, people should state how much is their capital. Some say they have 500,000, some say they have 20,000, some say they have 1 million in their savings. So this tells us that a lot of us here need to work on our savings, right? There's no shortcut to building wealth and raising capital. Foundation remain foundation. There are other options, but those other options will rely on, it's easy for jitters to raise money now because we are at a place where even you will be comfortable giving us your money because of how far, what we've been able to do on our own with the little that we have. So investors need to understand how their capital will be used, including property type, location, financial projection, timeline, risk assessment, and expected returns. So what are the strategies? Number one, network globally. A lot of us have a challenge where all our network are local people, right? Everybody is restricted to, the city you are based in. Everybody is restricted to a particular location. How do you network globally? You have to begin to think of networking globally. How do I build friends in Germany, in Croatia, in America? And why is that important, you will say? Sometimes you may not be able to raise certain capitals in Nigeria, and the place you may be able to raise in other countries, they are very much open. Look at what's happening in the Nigerian tech ecosystem. A lot of our tech guys are easily able to raise capital, okay? Easily. They are raising capital from the US market, okay? And they are not even able to raise capital from Nigerian market. So you have to network global. So attend events, even if they are virtual, where people are attending those events from, different parts of the world, online conferences, international conferences. Travel there, right? Take a stand at events, and be there. Build a strong track record and credibility. Build a strong track record and credibility. One of the biggest assets to GTEx is because this year makes it 10 years that we have existed as a real estate development company. So in 10 years, it's been easy for people to look at us and say, well, for these guys to have existed for the last 10 years, we think there's something there. Okay. We think there's something there. We think we can trust them to an extent. They've been here for 10 years. So we need to give them a benefit of the doubt. And this has been so helpful for GTEX. Oh, we know what they've done before. Let's give them a chance. Track record, nothing beats it. So starting your real estate company today and expecting you raise 100 million in your first year is not impossible, but it's not realistic. Except if you have been doing other businesses before and you build track record in those other businesses and you are now just also expanding to real estate. Yes, that can work because you're also bringing the credibility you built in those other businesses into the real estate sector. That's how it works. So very, very important that we understand this, okay, that the track record, there are some things we've tried to achieve all these years. Nobody gave us a chance. 10 years later, they're giving us a chance. You need to understand how the psychology works with a lot of people. Some people will watch you for 5 years before they ever do business with you. Some people will not touch you for the first 3 years of your business. They just want to see whether you will stay, whether you'll be there. Credibility and track record. Powerful. Powerful. What have you been doing? What are you known for? What are your antecedents? Create compelling investment proposal, right? Create compelling investment proposal. What is the need for these investors? What will they get? If they give you their money, what will come to them? Create that. Number 4, leverage networking and relationships. So sometimes you cannot reach certain people, but their friends can reach them, right? Sometimes you cannot get certain things, but you know somebody who's can use their. So in other words, you may not have credibility, right? But you can leverage on a credible relationship. Sometimes you don't have a track record, but you can leverage on track record of another company, right? This is part of the reasons why I tell people when you work with a credible organization, don't joke with your relationship with them. Don't burn bridges because tomorrow that may even be what will open the door by you saying, oh, I used to work with GTEX. I was in charge of GTEX so XYZ. Please can somebody get admin, get Queenette here, right? Get her to join and let her come here and put her spotlight her, please. Because this is a seminar. So it's important to understand the place of, credible relationships that you are leveraging on. Farouk as well. Get them, the two of them here. Credible relationships. You may not have a track record, but you're leveraging on somebody else's track record. And so, oh, I used to work in this organization and I was in charge of XYZ when I was working there. This was what I was able to achieve when I was working with them. And those things go a long way in helping you because people are then looking at you with the eye of where you're coming from. That's why don't burn bridges, right? So you're coming from a real estate company, but you have never built one. Then you start your real estate company. You can quote that you already have 10 years real estate experience because you are quoting where you are coming from. As long as you don't burn bridge, people can call that company and say, is it true this person worked for you for 10 years? Say yes. Say, okay, that's all we need to know. And that may just be why they will still go ahead and do business with you. So use technology and social media for outreaches. Oh, don't joke with this. Go all out. Put it on social media. We're doing this. We stand for this. This is what our company is doing. This helped to open bigger doors, right? Bigger doors for you. Leverage on social media to push what you do and what your company stands for. Have we learned something today? Can we raise capital now? Come on, talk to me. How many of you can raise capital? Right? So, what are the best practices for attracting investors? Transparent communication. Always provide regular update, financial report, and performance analysis to investors. Trust is key to maintaining long-term relationship. Number 2, targeting the right investors. Understand the type of investor you are targeting, institutional versus individual. Tailor your investment pitch to their preferences and risk profile. Number 3, long-term vision. Focus on building long-term value rather than quick profit. Investors value stable and sustainable growth. All this one, I will give you 100%, will give you this. Real investors would rather work with an organization that can consistently give them 10% every year, okay, compared to those who would promise them 40% and all of that, and there's no track record. So let's look at common pitfall when you are trying to raise money. Over leveraging. Relying too highly on debts can lead to financial strain if the market turns. Many people, everything is on debt. There's nothing in their business that is their own money. Over leverage. So if anything goes wrong, boom, they're in trouble. Come on. Let debt be maximum 20% of your total asset. Don't raise more than, yes, always do that. Okay? 2, value, failure to do proper diligence. So no research, potential market partners thoroughly can lead to costly mistakes. So do your research. Before we expanded to US, we knew Trump was going to win. We knew Trump presidency by the second year or so will lead to growth, big growth in the economy because of some things he's going to do. Number 3, misaligned investors' expectation. So failing to manage investors' expectation regarding return or timeline can lead to dissatisfaction. So manage your investors' expectation. I always say this to our leaders in our organization. Manage the expectation. If you know you can pay them on Monday, tell them the best you can do. Okay? The best you can do is in 2 weeks' time. And still go ahead. If the money come, still pay them on Monday. They will respect you that way. Than for you to say Monday and then something comes up that delays it to 2 weeks' time. They'll say you don't have credibility. So manage expectation. Give them a worst case scenario. One of the things we do when we give returns, we always give a lower number because we just don't want to promise something ridiculous, okay? That it then becomes difficult for us to keep. So thank you for listening. Did you get value, guys? I hope you got value. If you got value, type I got value, I got value, I got value, I got value. Okay, did you get value?